The purpose of financial statement analysis is to analyze balance statement, to analyze income statement, to analyze the cash flow report, and try to get some conclusions based on this. Also, the first part of financial statement analysis is a balance sheet analysis, and in case of the balance sheet analysis, we want to analyze the assets, liabilities, and equity of the company. As you already know, balance summarizes the company's assets, company's liabilities, the equity, in some specific point of the time. It can be at the end of year, it can be at the end of the semester, it can be at the end of quarter. So it is snapshot at the end of some time period. And these three dimensions give investors or financial analysts or financial managers good understanding about what company owns and what company owes. So we want to read balance statement with the glasses of financial analyst to try to understand the proportions of company's assets, the proportions of company's liabilities, and also the equity. Visually, if we're looking at the balance, we have two main information. We get two kind of information. First one is where the money is going to. The left hand of the balance statement shows where company allocated its finances. So the breakdown, as everyone knows, they can have current assets, they can have long-term assets, there can be intangible assets also. So the left hand of the balance shows where the money is going to, and right part of the balance statement shows where the money is coming from. So this shows the sources of finances that company reach in order to get those assets. So a company can get finances whether through liabilities or through the equity, and there is also breakdown in all those accounts. So this is what we try to understand during analysis of balance statement. And as you know, the equation of the balance statement, always when we talk about balance statement, we need to have in mind that assets and liabilities or plus equity are always equal. So balance statement should always balance out. And always talking about balance statement, remember the mechanism of scales. So right hand is equal with the left hand. So the formula basically of balance statement is this one, and you might know that. Assets are equal, liabilities plus equity. And we need to make sure that everything is correct. So with the eyes of financial analysts, we need to analyze two sides of the balance statement, and asset size, and also the liabilities plus equity side. And we need to understand that all the logic of the business is that company has to pay for all the things that it owns by whether borrowing money through liabilities or through taking from its investments. So there are two ways, and we want to understand the proportions of those two subcategories. Assets, liabilities, and equity are comprised in several smaller accounts, but as analysts we want to look from the global point of view and understand the breakdown of assets into current and non-current assets only. We want to see what is the proportion of current and non-current liabilities. We want to see the breakdown of equity, which part of the equity is common stocks, which part of equity are preferred stocks, which part of equity are retained earnings. So we want to understand the big picture of the balance statement. We don't need a detailed breakdown, and during project we're practicing the same approach. We want to simplify and understand the structure of balance statement. So those accounts that I mentioned, they can break down the specifics of the company's finances. If we need more information, we can go in particular case to more details and try to understand the specific breakdown of specific account. But generally in our project, because of time considerations, because of the efficiency of learning procedure, we will use the major breakdown analysis of the balance statement. Here is a very nice video that will visually show you how the balance statement is structured, and you will remember, it will help you to remember about the concepts that you learned from the accounting sessions, and also it will help you to look in the balance from point of view of investments and also from point of view of financial management. So
a balance sheet is a statement of the assets, liabilities, and equity of a business or other organization at a particular point in time. A balance sheet can also be described as a snapshot of a company's financial condition. A balance sheet is broken up into three sections: assets, liabilities, and equity. The difference between the assets and the liabilities is the equity of the company, also known as net assets, net worth, or capital. So, you're starting a business. You go to the bank and get a loan. On your balance sheet, this loan shows as a liability, as it has to be repaid to the bank. It also shows as an asset for the same amount as you have the cash to spend. Thus, the balance sheet is balanced. You need to buy a computer for your new business. The cash in your assets decreases, but your new computer asset helps balance this. As you sell to your customers, your profits are recorded as retained earnings in the equity section. The cash from these profits is recorded in the asset section, and the sheet remains balanced. Every month you make a loan payment to the bank. Your liabilities reduce by the amount of the payment, and your cash is reduced by the same amount. If at any point you need to find out your business's worth, go back to the formula from before. Assets minus liabilities equals equity.
As you understood, the balance statement is very important financial report, and financial analysts have to analyze them in order to be able to make some recommendations to investors. Financial managers have to analyze the financial statements and balance sheet in order to be able to manage company efficiently. In next sessions, we will talk more about balance statement analysis. Also, we will cover topics about analysis of other key financial statements. Thank you very much, and you have a good time. Bye-bye.